If you were to invest with an aggressive investment plan of $2,400 a month, you will not achieve any meaningful amount of wealth after 10 years of discipline. If I'm being honest, the median income in the US and UK is about 48 to 60K per year. And let's be honest, the average middle class or poor person isn't putting aside $2,400 a month to invest into a market tracking index fund aggressively based on those salaries. In that hypothetical scenario where someone did follow this plan and the market generously averaged a 10% return, your accumulated wealth will be less than $500,000. My point is, stock market investing performs best if you already have a substantial source of income. A lot of YouTubers claim the stock market is the holy grail of getting rich. But following this advice stops you from staying poor at best. But you most certainly will never win. Especially at an age where you're still in your prime to enjoy life. So all of these metrics were me being very generous. You're welcome. If you have been watching videos on how to invest in the stock market, I need you to unlearn all the trash you most likely heard about stock market investing. The rich understand the stock market's purpose is not there to be your main source of building wealth, but to supplement and increased leverage opportunities. But there is a way to get better returns from investing than simply buying an broad market ETF or index fund. Watch till the end and you will learn how to get market-beating returns every year. This video isn't for people who never heard of the stock market and index funds and ETF, but here is a simple explanation. Index funds are fancy jargon for an asset that reflects a large part of an industry or economy. Typically, if you lose all your money investing in these, then you have bigger things to worry about because your country is falling apart, my friend. So if you see investing as risky and scary, then understand how illogical your priorities are. Even though higher returns can be achieved from buying a single company, we want our wealth empire to be as easy to manage as possible. So the students of the Billionaire Blueprint don't invest in individual companies. The exception is if you're an insider, which is beyond the scope of this current video. Now that you understand that the stock market will not get you rich in a reasonable amount of time, let's talk about how people invest, like pros to maximize this asset class. If you watched my last video, you understand how to think properly using solution-oriented analysis. Unlike what you've been brainwashed to think in school. 90% of problems in life have multiple solutions and ways of obtaining said solution. So if we phrase this as the problem is, I'm poor, or at the very least I don't have enough money to live as I please, with a sub-stipulation of wanting to enjoy life while you're young and healthy, then the solutions that won't work becomes rather obvious. If you're someone who investing to simply not be poor in retirement, then following traditional finance advice is still viable. But this is the Billionaire Blueprint, where I show you how to make the kind of money that colleges will protest about. So I'm speaking to my fellow degenerates when I say this. You need to leverage everything you can in the world of business and finance. The core types of leverage to use in the modern day are technology, media, money, people, and most important, systems. I will explain how to master these leverages in future videos, so if you haven't already, subscribe and hit the like button to not miss it when I do. Today we're going to talk about financial leverage, aka money, and how we will use it to get market-beating returns and consistently grow our wealth faster than those living life by playing it safe. To move like a billionaire, you need to refrain your goal from focusing on return on investment to accumulating AUM, also known as assets under management. AUM is your number one goal. The second goal you need to understand is free cash flow. FCF is the cash a business generates after taking into consideration cash outflows that support its operations and maintain its capital assets. Simply, the money an asset generates minus the money it costs to keep an asset running and growing equals free cash flow for all intents and purposes. And if that's still too complicated, let's give an example everyday people can understand. Let's say your house is an asset and you rent it out. Your free cash flow will be what's left after collecting the rental income from paying the mortgage and other costs to maintain the home, aka the asset. If you have money left over, you have free cash flow, and if you don't, it's called negative free cash flow. Apply this logic to investing with financial leverage and you will eventually realize money is everywhere. It's just most of you don't speak the language of money. I know some accountants want to get hung up on semantics, but I'm trying to keep it simple for those beginning their financial awakening. Now that we established definitions, let's get to the good part. Financial leverage can be maintained infinitely if you learn how each leverage instrument works. For example, a mortgage is a leverage instrument attached to the house, but if your house falls in value, you will not lose the asset. As long as you can service the debt repayments of the mortgage, it doesn't matter what valuation the housing market gives. On the other hand, we have financial leverage that's backed by assets like stocks, business, and crypto. Loans against these assets typically have a double stipulation of you paying interest on the debt you use against this asset call, while also being at risk of losing the assets if they fall a lot in value. It's quite simply a double-edged sword. This is why real estate investments are seen as a lot less risky. But what if I told you there's an effective method of borrowing against your stocks that allow you to greatly reduce the risk when using margin and leverage? For starters, you never want to leverage on margin more than 35% of the value of your stocks, even if the stocks you hold are more stable than the average ETF. Only time you should raise this number is if your total monthly income exceeds the max margin that the account can take. If not, don't risk it. Billionaires are experts at risk management because they understand that the masses stay poor because they are ruled by fear of risk, and the rich gain wealth because they truly understand that fear can be overcome with information. They build their stock account around a market index fund like SPY, FTSE, or a major country index, with a minority stake in a low volatility cover call ETF that produces monthly income to cover the margin expense, because we're here for free cash flow, remember. And the last step is they build their investment account to whatever size that requires them to be able to sell covered calls of the national index. They want to get 100 shares of a market index ETF like SPY or QQQ as fast as possible to begin selling cover calls. Not counting leverage through margin. Just adding covered calls to your buy and hold strategy of index funds will almost guarantee market-beating returns to those who just do the mainstream buy and hold and nothing else. But it doesn't stop there, guys. If you calculate based on cash return, this strategy can get you a net average annualized return of 21%. So using margin plus cover calls plus actual capital invested, it would look like this in comparison. John follows traditional investing and puts his money in index funds, and maybe even worse, a tax retirement account, because he says he wants to achieve financial freedom at a young age. He invested $100,000 into his brokerage account over the year for easy math. Chad followed the Billionaire blueprint and understood that leverage and smart risk management is the key to business and financial success. He invested $100,000, while also taking out a margin aka debt loan against his stocks for $35,000, following the 35% rule, with a portfolio starting at $135,000. Chad also followed the Billionaire blueprint on selling covered calls of SPY, S&P 500, generating an additional $500 a month, which is a realistic expectation for buying low-risk covered calls for $100,000 worth of shares in SPY. He also invested $35,000 from his loan on a covered call ETF that earns him a yield of 10% in cash flow annually, and potential covered call gains depending on the ETF you pick. But since he is using debt to acquire this asset, he has to pay interest on this debt. Using today's interest rates for margin, let's say he pays 6%. Chad is a blueprint investor, so instead of reinvesting the money from the covered call investment, he uses it to pay down his margin balance of $35,000. Similar to having a renter pay down your mortgage on a property. Chad now has an asset servicing his margin debt with no extra work on his end. In a good year, the market returned 10%. John's traditional ETF portfolio is now worth $110,000. Chad, who mastered the Billionaire blueprint, grew his $100,000 by 10%, and the covered call ETF that he bought for $35,000 has appreciated by 7% since they typically trail the market when it comes to appreciation. Chad is a blueprint investor, so he didn't just wait for his SPY shares to grow, he loaned them out, earning $500 a month, and after 1 year he earned an additional $6,000 from sale in premium. Let's not forget that his cover call ETF he bought using his margin loan paid 10% in cash distributions or dividends. That totaled $3,500. Add the 7% appreciation of $2,450 of the underlying shares, and subtract the 6% interest for the debt, $2,100. Chad's net cash flow for his loan was $3,500 in dividends minus $2,100 in debt payments equals $1,400 in gains. And a drum roll for Chad's portfolio total, please. Chad's total portfolio is worth $154,850. Recap: he started with $100,000, borrowed $35,000 for a total of $135,000. 1 year later, after a 10% gain in the market, he has earned $19,850 in net gains. Remember not to calculate the $35,000 in his cash-on-cash return, since the money isn't his. So that means he used $100,000 to earn $19,850, which is a 19.8% return, while John earned only 10%. If the market fell down, Chad will still outperform due to the cash flow he would make from selling cover calls. Long story short, there's a game to money that 90% of you have no idea about. If you went to a financial advisor and said you want to earn 15 to 25% a year average over 10 years, he would tell you it's impossible. Just remember, folks, the smartest thing Chad should do is take his profits and pay down his debts. Never reinvest 100% of net profits when leveraging variable interest rates. Your goal is to pay it down the debt to keep the ownership of the asset that prints you money, or convince another party to buy your debt with a fixed-rate, interest-only debt option down the road. But that is beyond the scope of this video. But don't miss it when we go over debt restructuring and arbitrage strategies. This is something you will never learn anywhere else on YouTube. If you haven't subscribed by now, then I think you're beyond saving at this point. Remember that margin interest rates are adjustable. That's why it's important to stick to the 35% maximum rule, so you will always be able to cover your risks even if the market crashes. Here is a list of the worst crashes in the United States. Great Depression. October 29, 1929, 89% drop from its all-time high, taking years to recover. Black Monday. October 19, 1987, 22.6% from its all-time high, but recovered fairly quickly, after a blip in the market. Dot-com bubble crash. 2000 to 2002 dot-com bubble, 80%, but let's get real, the poor were buying trash assets sold to them by the rich. And someone following the billionaire blueprint won't be invested in companies like those during any period of time, because he understands solution-oriented critical thinking. Global financial crisis. 2008 to 2009, the S&P 500 lost nearly 60% from its all-time high, but took 15 to 17 months to bottom out. This would require strict cash flow management, but still won't liquidate Chad's portfolio. 2020, the market fell 34% in 1 month, one of the sharpest declines, but not nearly enough to collapse Chad's portfolio. Chad's method encompasses maintaining his assets during any of these scenarios, excluding the Great Depression. But let's get real, if that happened again, the last thing you're worried about is the stock market. There is no such thing as risk-free in the world of money. That is an ideal the poor and fearful hang on to. Reframe your obsession with things seeming risk-free and obsess over risk management instead, and you will be well on your way to millions and billions if you are lucky and relentless. The goal of the Billionaire Blueprint is to convert as much money into cash-producing assets as soon as possible while maximizing them. Please understand what I'm about to say is still a slight oversimplification of this strategy to get a general idea out. This isn't a simple video, but I gave enough breadcrumbs to help you find out the big secret of the world of finance. There will be some of you who want to have your hands held and told exactly what to do, but you'll never learn to fish on your own that way. If you're that kind of person, you need to leave this video immediately, because the minute there isn't someone there to hold your hand and tell you what to do, you will lose all your money and assets due to your own stupidity and arrogance. I need to train your minds to be problem solvers, and if I were to give direct solutions to in-depth complex financial situations, my going rate will be beyond what any of you could afford. That is why my mission is to democratize high-end financial information one video at a time. Because if you are only interested in getting money but not evolving your thinking to a higher state, you won't be able to maintain yourself at the level my knowledge will bring you. That is why a lot of rich athletes, celebrities, and lottery winners rarely keep their money through the duration of their life. It's because they never learned the language of money. So don't let greed overcome discipline. That's all for today, and you have just downloaded another piece of the Billionaire Blueprint. Until next time.